Let's talk trading, the world of big promises and even bigger pitfalls. The truth? Every successful trader has a trail of mistakes behind them. Today, I'm sharing the biggest blunders new traders make and the real stories behind them. Forget the highlight reels on social media. Let's get real about what can go wrong. These are the lessons that matter, the ones that can save your account. If you're new or struggling, this is for you. Stick around, because the last mistake we cover can wipe you out in a single afternoon. Let's dive in. Mistake number 1. A classic pitfall that many new traders stumble into: trading without a plan. It's like setting sail without a map, hoping the winds will carry you to treasure. More often than not, you'll end up lost at sea. Meet Alex, a young, enthusiastic individual eager to make his mark on the market. He put his entire $10,000 savings, every single hard-earned dollar, into a hype tech stock, a company everyone was talking about, fueled by social media buzz and promises of exponential growth. No exit plan, no stop loss, just vibes. Pure, unadulterated FOMO driving his decisions. He was riding the wave of hype, hoping it would carry him to riches. At first, he was up 15%. He felt like a genius, a stock market prodigy. Then bad news hit, a negative analyst report, a product recall, something that shook investor confidence. And the stock tanked, free-falling faster than he could have ever imagined. Alex watched his gains vanish, the initial euphoria replaced by a growing sense of dread, then his capital. The money he had worked so hard to save, slowly eroding before his eyes. Paralyzed by hope and fear. Hoping for a miracle, fearing the inevitable, he finally sold after losing nearly half his money. A painful lesson learned the hard way. The problem? The root cause of this financial disaster? No written plan, no rules, just emotion. A recipe for disaster in the volatile world of trading. Before you trade, before you risk a single dollar, write down, why am I entering? What's the rationale behind this trade? Where do I take profit? At what price will I secure my gains? Where do I cut losses? At what point will I admit I was wrong and exit the trade to protect my capital? A plan isn't glamorous. It doesn't offer the thrill of impulsive action, but it's your shield against panic, your anchor in the storm. Without it, you're gambling, not trading. You're relying on luck, not skill. Don't be Alex. Learn from his mistakes. Make a plan, stick to it, even when your emotions are screaming otherwise, and let it guide you when things get rough. Let it be your compass in the turbulent seas of the market. The market doesn't care about your gut feeling. It's a cold, calculating machine. Your plan is your only defense, your only way to impose order on the chaos. Use it, embrace it, and trade with confidence. Next up, ignoring risk management. This is a critical mistake that can wipe out even the most promising traders. It's about more than just knowing the risks. It's about actively managing them. Let's look at a real-world example. Sarah, an enthusiastic but inexperienced investor, researched a biotech stock. She was convinced it was a sure thing. Fueled by optimism and a bit of greed, she bet $20,000, her whole portfolio, on FDA approval. She saw the potential for massive gains and let that cloud her judgment. She thought, this is it. This is how I make it big. But the market is rarely so predictable. The drug failed to receive FDA approval. The news sent shockwaves through the market. The stock crashed 70% in a matter of hours. The initial excitement quickly turned into panic as investors rushed to sell. The value of Sarah's investment evaporated before her eyes. Sarah lost most of her money in minutes. Her dreams of financial freedom were shattered. The emotional toll was devastating. Why did this happen? She broke the golden rule, a fundamental principle of risk management. Never risk more than you can afford to lose on one trade. It sounds simple, but it's a lesson many learn the hard way. It's about understanding your risk tolerance and setting appropriate limits. Professionals risk 1 to 2% per trade, carefully calculating their position size based on their overall capital. They understand that consistency and longevity are key to long-term success. Not everything. Don't put all your eggs in one basket. Diversification is crucial for mitigating risk. Position sizing is everything. It's the cornerstone of effective risk management. It determines how much you stand to lose on any given trade. It's not about how much you make when you're right, because everyone has winning trades, but how little you lose when you're wrong. This is what separates successful traders from those who flame out quickly. Even the best traders are wrong often. It's part of the game. No one can predict the market with 100% accuracy. They survive by limiting losses, using tools like stop-loss orders to automatically exit losing positions. Protect your capital. It's your most valuable asset. If a loss would devastate you, If it would keep you up at night, your position is too big. The market doesn't care how confident you are, how much research you've done, or how sure you are about a trade. There are no sure things, only smart risk management. Embrace uncertainty and focus on controlling what you can. Don't let one bad trade end your trading career. Learn from your mistakes and keep moving forward. Scale down your position sizes, especially when you're starting out or testing a new strategy. Diversify your portfolio across different asset classes to reduce your overall risk exposure, and always respect the risk. The market is a powerful force and it demands respect. Survive to trade another day. That's the ultimate goal. Let's talk about emotions. Those powerful undercurrents that can make or break a trader. They're a natural part of the human experience, but in the fast-paced, high-stakes world of trading, unchecked emotions can lead to disastrous decisions. Understanding and managing your emotional responses is paramount to achieving consistent profitability and longevity in the market. Emotions can be your biggest trading enemy. They cloud your judgment, distort your perception of risk, and push you to act impulsively, often at the worst possible time. Recognizing this inherent danger is the first step towards mitigating its impact on your trading performance. Take Mike, for example. Mike chased a crypto rally out of FOMO, the fear of missing out. He saw everyone else making money and couldn't stand the thought of being left behind. This emotional impulse overrode his rational analysis and led him straight into a classic trap. He bought high, fueled by the excitement of the moment, but without a clear strategy or understanding of the underlying risks. As soon as the market showed signs of weakness, panic set in, and so he sold low, locking in a loss and confirming his worst fears. This knee-jerk reaction was driven by pure, unadulterated panic, a common pitfall for inexperienced traders. Then, to add insult to injury, he watched the price recover, mocking his hasty decision. The market, as it often does, rebounded, leaving Mike kicking himself for selling at the bottom. Driven by regret and a renewed sense of FOMO, he jumped back in, repeating the cycle of buying high and selling low. This is a classic example of emotional trading, where decisions are driven by feelings rather than logic. Fear and greed, the twin demons of the trading world. These powerful emotions drove every decision, leading to a series of predictable and costly mistakes. Mike's story is a cautionary tale, highlighting the dangers of letting emotions dictate your trading strategy. This emotional loop destroys accounts, one bad trade at a time. It's a vicious cycle that can quickly erode your capital and your confidence. Buying high, selling low, the antithesis of successful trading. It's a recipe for disaster, yet it's a pattern that many traders fall into, especially when they're driven by emotions. Over and over, the same mistakes, the same losses, the same frustration. This repetitive cycle can be incredibly demoralizing, leading to burnout and a loss of faith in your ability to trade successfully. The fix? How do you break free from this destructive pattern? A written plan, a detailed roadmap for your trading activities. This plan should outline your entry and exit criteria, risk management rules, and overall trading goals. And a trading journal, a record of your trades, your thoughts, and your emotions. This journal serves as a valuable tool for self-reflection and identifying patterns in your trading behavior. Write down why you enter a trade, the specific reasons that led you to believe it was a good opportunity, and exit trades, documenting your rationale for closing the position, whether it was a profit target, a stop-loss trigger, or a change in market conditions, and most importantly, how you feel during the trade. Were you anxious, excited, fearful, or confident? Spot your emotional patterns by reviewing your trading journal regularly. Identify the triggers that lead to emotional trading and develop strategies to manage those triggers and break them, consciously working to replace emotional reactions with rational decisions. Trading is a game of discipline, a test of your ability to stick to your plan and resist the urge to act impulsively. Not impulse, not gut feelings, but calculated decisions based on sound analysis and a well-defined strategy. When emotions scream, when your heart is pounding and your palms are sweating, follow your plan, stick to your rules, and trust in your analysis. The moment you let fear or greed take over, the moment you abandon your plan in favor of an emotional impulse, you've already lost. You've surrendered control to your emotions, and the market will exploit that weakness. Master your mind, cultivate emotional discipline, and develop a resilient mindset. or the market will master you, turning you into just another statistic in the long and unforgiving game of trading. Overtrading, the silent account killer. Ben thought more trades meant more money. He chased tiny profits all day, every day, but fees, slippage, and random market noise ate away his gains. His account shrank, not grew. Overtrading is usually impatience or boredom in disguise. Pros wait for high-quality setups. They're snipers, not machine gunners. Set a daily trade limit. Focus on quality, not quantity. Sometimes the best trade is no trade at all. Don't force the market to pay you, it won't. Trade less, but trade better. That's how you grow your account. Beware the hot tip. Chloe followed a guru into a penny stock, trusting hype over homework. The stock spiked, then crashed as the guru dumped shares. Chloe lost almost everything. She was the exit liquidity. The lesson? Never outsource your thinking. Do your own research. What does the company do? What are the risks? If you don't understand it, don't buy it. Hot tips are traps for the lazy and greedy. Build your own conviction. Only trust yourself with your money. After you've done the work. Real wealth comes from diligence, not shortcuts. Don't be someone else's exit. The most tragic mistake? Not learning from your losses. Mike kept making the same emotional trades, blaming the market instead of himself. His account was a graveyard of repeated errors. The fix: keep a trading journal. After every trade, record your setup, entry, exit, and what you could improve. Be brutally honest. This is your private feedback loop. Losses are tuition. Learn the lesson, or you're just paying for pain. Review your trades like a pro athlete reviews game tape. The best traders are detectives, always searching for their own weaknesses. Don't let ego blind you. Reflect, adapt, and grow. Don't be Mike. Be the detective. The deadliest mistake: trading without a stop loss. David bought a safe stock, no stop loss, and disaster struck. Overnight, it crashed 70% on bad news. He lost nearly everything in seconds. A stop loss would have limited his loss to 5%. Yes, stops can get hit on noise, but that's cheap insurance against catastrophe. Every trade needs a preset stop loss, no exceptions. "I'll watch it closely" is not a plan. Your emotions will betray you. An automatic order won't. Respect the market's power to surprise you. Protect your capital at all costs. Small losses are survivable. One huge loss can end your trading career. Make stop losses non-negotiable. There you have it, the 7 deadly trading mistakes. Trading isn't luck or shortcuts. It's discipline, risk management, and constant learning. The stories of Alex, Sarah, Mike, and others are your roadmap. Learn from them. Success is a marathon, not a sprint. Protect your capital and keep improving. What's the biggest trading mistake you've seen? Share in the comments. Let's learn from each other and build a smarter trading community. If you found this helpful, subscribe for more real trading lessons. Thanks for watching. See you next time.